If you think the UK housing crisis is just about high prices, think again. Right now, in parts of Britain, it's not prices that are soaring, it's values that are sliding. Entire neighborhoods are quietly losing value. Landlords are dumping properties. First-time buyers are pulling out. And families. They're being forced out, not by opportunity, but by pressure. Welcome back to UK Housing Reality, where we expose what's really happening behind the property headlines. Today we're breaking down 5 UK cities that are crashing right now. And when I say crashing, I don't just mean prices dipping by 1 or 2%. I'm talking about stalled markets, rising repossessions, rental squeezes, investor exits, and serious downward pressure that's pushing ordinary families to the edge. Let's start with Birmingham. Birmingham was supposed to be the powerhouse of the Midlands. Billions poured into regeneration. HS2 hype drove investor speculation. New build flats popped up everywhere. But here's the problem. Supply exploded just as mortgage rates surged. Investors who bought city center flats off-plan are now struggling to sell. Some developments are seeing price reductions of 10 to 15%. Compared to peak 2022 valuations, rental yields aren't covering new mortgage costs for many landlords, refinancing at higher rates, and service charges in apartment blocks have jumped sharply, scaring off buyers. Families looking for stability are finding themselves priced out of safer suburban areas, while city center stock sits stale. That imbalance is not healthy. Next, London. Now, before you say London never crashes, let's be specific. Prime central London may be resilient long-term, but parts of outer London are under real strain. In boroughs where affordability was already stretched to the limit, higher mortgage rates have hit like a hammer. Transactions have slowed dramatically. Sellers are quietly accepting reductions. Buy-to-let landlords facing tougher tax rules and higher interest costs are selling up. When landlords exit, rental supply tightens and rents rise. That forces working families further out, sometimes beyond the M25 entirely. A softening sales market combined with brutal rental pressure is creating a squeeze from both sides. That's not stability, that's stress. Now let's talk about Manchester. Manchester was marketed as the northern investment hotspot. Overseas, buyers piled in. Luxury apartment towers transformed the skyline. For a while, prices surged, but yields have compressed. Build-to-rent schemes are competing heavily, and new completions are hitting the market into weaker demand conditions. So, landlords are discounting to exit quickly. At the same time, local wages have not kept pace with property price growth. First-time buyers are struggling to secure mortgages at current stress-tested rates. When demand cools and supply keeps arriving, prices soften. And when investors retreat, momentum disappears fast. Families who stretched to buy at peak prices now face uncertainty if values dip below what they paid. Liverpool is another city showing cracks. Liverpool saw strong growth after years of underperformance. It became attractive for yield-hungry landlords. But parts of the market were heavily investor-driven. That creates volatility. If investors decide returns no longer justify the risk, especially with regulatory changes and rising costs, they sell. And when multiple landlords list properties at the same time, prices can drop quickly. Some areas are already seeing longer selling times and more frequent price reductions. For lower-income families, rising rents, combined with fewer affordable listings, are pushing them towards smaller properties or different towns altogether. Now let's look at Nottingham. Nottingham is a classic example of a city caught between affordability pressure and investor retreat. It has a large student population, which supports certain segments of the rental market. But higher borrowing costs have made buy-to-let refinancing painful. Landlords facing energy efficiency upgrade costs are choosing to exit instead of invest. Further, that reduces rental stock in some areas, while sales listings increase. When supply rises faster than demand, prices adjust downward. Families who relied on relatively affordable rents are seeing contracts renewed at significantly higher rates or being asked to leave if the landlord decides to sell. Here's what links these cities together. Higher interest rates have fundamentally changed the maths. During the era of ultra-low rates, almost any property could look like a good investment. Cheap debt masked risk. But now, mortgage rates above 5% have exposed weak fundamentals. If local wages cannot support high prices, something has to give. Either prices fall or transactions freeze. And in many places, we're seeing a bit of both. At the same time, landlords are under historic pressure. Section 24. Tax changes reduced profitability. New regulations around energy performance certificates require upgrades. Insurance costs have climbed. Maintenance costs have surged due to inflation. Many small landlords, the ones who own 1 or 2 properties, are deciding it's no longer worth it. When they sell, the market absorbs more supply. But here's the twist. In some of these cities, even as prices soften, rents are still rising. That's because when landlords exit, rental stock shrinks before owner-occupiers step in. The transition creates chaos. Families caught in that middle phase face higher rents, stricter referencing, and fewer options. If they can't buy due to tighter lending criteria, they're stuck. Another key factor is wage stagnation. Real household incomes have struggled to keep pace with inflation. Food, energy, council tax, everything costs more. That leaves less room for mortgage payments or rent increases. Affordability ceilings are being hit hard. And then there's the psychological factor. Property markets don't just move on numbers. They move on sentiment. When buyers believe prices might fall further, they wait. When sellers fear bigger losses ahead, they accept discounts. That shift in mindset can accelerate downturns faster than most people expect. Now, does this mean a 2008-style crash is guaranteed? Not necessarily. Lending standards today are stricter than they were before the financial crisis. Most homeowners are on fixed-rate deals, which delays forced selling. But as those fixed deals expire over the next year or two, refinancing shocks could increase distress in certain areas. The real story isn't just about numbers on property portals. It's about families relocating because rent jumped 20%. It's about parents moving back in with relatives. It's about key workers commuting longer distances because they can't afford to live near their jobs anymore. These 5 cities are not collapsing overnight, but cracks are visible. Transaction volumes are down. Price reductions are more common. Investor enthusiasm has cooled, and affordability is stretched to its limit. If you're a buyer, this could mean opportunity, but only if you're cautious. Don't rely on 2021 comparables. Negotiate hard. Understand local supply pipelines. Check service charges. Stress test your own finances. If you're a seller, realism is critical. The market is not what it was 2 years ago. Pricing aggressively high and hoping for bidding wars is unlikely to work in many areas. And if you're a renter, awareness is power. Monitor listings closely. Negotiate renewals early. Explore alternative neighborhoods before you're forced to move. The UK housing market isn't one single story. It's hyperlocal. But the pressure points we're seeing in Birmingham, London, Manchester, Liverpool, and Nottingham reveal a broader shift. The era of easy growth is over. The era of adjustment has begun. An adjustment can be painful. If you found this breakdown helpful, make sure you subscribe to UK Housing Reality. We cut through the spin and bring you the data-driven truth about what's really happening across Britain's housing market. Drop a comment below. Is your city slowing down? Are prices being reduced? Where you live? I read every comment. Until next time, stay informed, stay realistic, and remember, in property, the numbers never lie, but the headlines often do.